If you look at the top 10 consistently high returning stocks from 1995 to 2020, here you will notice the first three names. Two out of those are banks, Kotak Mahindra and HDFC. Now, what has given them the ability to be on this list again and again, consistently giving great returns to their investors? I really want to deep dive into that in this course, and I'm going to tell you all about what enables these banks to generate consistent returns over and over again for their shareholders. This table right here shows the financial statement for HDFC Bank for the financial year that ended in March 2019. This table right here shows the financial performance for SBI Bank for the years 2018, 2019 and 2020. What's the one common thing that you can notice? Well, the biggest observation that is to be made is interest income. Both these banks show that interest income is their main source of profits, revenue and everything. Now, what is interest income? Very simply explained, interest income is the income that a bank generates by the difference of the interest that they get from their borrowers and they give out to their depositors. So from here, it's clear to see that most banks generate most of their revenues from their lending activities. They give out loans of different kinds: car loans, bike loans, education loans, home loans, all varieties, and they get higher rates of interest than they give out to their depositors, whether it be through a savings bank, FD, whatever. Essentially, interest income is the biggest and the most revenue generating activity that a bank does today. Also, credit cards also fall in the interest income bracket. When you take a credit card from the bank and you don't clear your bills on time, you have to pay extremely high amounts of interest, and hence that also gets added to the interest income. Now that we've established how banks are making most of their money today, let's think about what gives them the leverage to actually make such high interest incomes. Have you ever thought about this? A bank accepts 100 rupees in deposits, and then how do they have the money to actually give out loans? Because if they're accepting the 100 rupee deposit, it's essentially a liability, because the depositor might walk in anytime and request for their money back. So this begs the question, how do banks have the capital to give out such huge loans and generate such huge interest income? Well, the answer lies in the main topic of this video, which is fractional reserve banking. Fractional reserve banking is the modern banking system which says that banks only need to hold a fraction of their deposits as liabilities, and the rest they are free to loan them out to their borrowers and generate income using that. Now, let's understand how fractional reserve banking works, why it's important, and what are the downsides of it. Now, to understand fractional reserve banking, it's good to start with 100% reserve banking. Now, in a 100% reserve banking system, if you go to the bank and give them 100 rupees, they have to hold all 100 of that in their deposits, in their reserves, because you might walk in anytime and ask for your withdrawal, and they are liable to hold all of the amount that you've deposited. So if you deposit 50,000 rupees, the bank has to have that 50,000 rupees at any given point as per 100% reserve banking. But fractional reserve banking, that's slightly different. Let's break the terms down. Fractional basically means that a bank only needs to hold a certain percentage of your deposit, not the entire thing, in their reserves, and this is fractional reserve banking. Typically, the fractional reserve banking rate is at 10%, which means that if you deposit 50,000 rupees, the bank only needs to hold 5,000 rupees in their reserves. The rest, they're free to loan out and make interest income on that. Let's talk about the history of fractional reserve banking, or FRB. So many people believe that the history of FRB dates back to the early Middle Ages, to the time of goldsmiths. There was apparently this unnamed goldsmith who was so smart that he realized that he could take a portion of his gold that he's taken from someone else and lend it out to borrowers and earn interest income on it. And then he would just sneak it back in before his depositors realized this. This is how people think that the origins of FRB started. But to be more concrete, the real origins of FRB started when people started storing a lot of their money in banks. So instead of the bank holding the same 100 rupees that you deposited in your name, they started holding it in pools. Now, what this enabled them to do was create a huge pool of all the deposits that they've accepted from different depositors, and then also lend them out. Because they never had to pay you the same notes that you deposited. They could pay you from the pool itself if you ever came for a withdrawal. This gave birth to the FRB system. Let's understand FRB with an example. Let's say you go to the bank and deposit $50 million. The bank has to keep 5 million of it aside, 10%, and they're free to loan the rest of the 45 million out to other borrowers. Now let's say Tom, a wealthy businessman, wants $45 million as a loan. He wants to start his own business. He can go to this bank and ask them, hey, can I have $45 million? And if the bank agrees terms, they'll loan Tom the $45 million. Now let's say Tom realizes that he only needs $5 million to actually get his business going. What he can do is deposit the rest of the $40 million in another bank so that he makes interest income on it. But do you see what's happening here? Now Tom essentially deposited $40 million in another bank, so they have a deposit of 40 million, and then they only have to hold 4 million of it, and then they can actually go out and loan the 36 million that's pending to someone else, who will then deposit it somewhere else, and that company will then be able to loan it out again and again and again, and you basically create a cycle of credit which creates a lot more wealth in the economy. Have you ever been in that situation where your friend asks you, hey, can you give me a loan? And you think to yourself, man, this might be a bad loan because your friend might not be able to pay you back. Well, this is the biggest disadvantage of FRB, and that is bad loan. Now, banks give out a lot of loans. They have a good process to figure out whether a borrower is credible or not, whether they can actually pay that back. But errors tend to happen all the time. A lot of banks have hundreds of NPAs, non-performing assets, or bad loans which they aren't able to recover. So essentially, this is the biggest disadvantage of FRB, and that is if a bank makes really unwise decisions on who to lend the money out to, they are putting a lot of customer deposits at risk, and if they never get paid back, well, it's the customer's money that they really lose, and all those customer deposits might get flushed down the drain, as we saw in the 2008 subprime crisis. There are a couple of other disadvantages of FRB as well. The first one is that FRB is a great stimulant of inflation. Due to this ongoing credit cycle that is created by FRB, the value of money actually reduces because new money keeps getting loaned into existence, and this causes a lot of inflation. The second one is bank runs. Now, what are bank runs? Essentially, it's when everyone makes a run to the bank to withdraw their money. Now, as we know, in FRB, the bank is only holding 10% as reserves. Let's say if all the depositors suddenly rush to the bank and say, hey guys, can we have our money back? The bank essentially will have no money to pay them, and this will lead to a huge loss in customer confidence and actually bring down the financial system. A lot of people who are non-believers in the banking system think of crypto as the solution to fractional reserve banking. They feel that banks loaning out money at 3 or 4 times the interest that they pay to their depositors, it's just unwise, and it's just completely driven by the profit motives of a bank, and they want to look at DeFi or decentralized finance as the solution, which is a crypto-based technology which will enable people to loan their money directly to borrowers, cutting out the middlemen. And this is what we're going to explore as we go ahead with more courses, more content. And in the next module, we'll establish how crypto is a good solution for people who are looking to move away from the banking system and move away from the points of failures that are presented by fractional reserve banking.